Hello everyone and welcome to today's webinar, What's in Store for 2024? My name is Nicola Cornish and I'm a partner here at PKF Francis Clark. I'm joined today by our Head of Tax, John Endicott, and our Managing Director of Francis Clark Financial Planning, Chris Rea. So 2024 is set to be the biggest election year in history, with over 60 countries, which represents over 50% of the world's population, heading to the ballot box. That includes the UK, the US, and India. Global events such as COP28, the conflicts in Ukraine, Gaza, and now Yemen are impacting on the financial and currency market. The UK does seem to have calmed down since the turmoil of autumn 2022, although the economy remains sluggish. Government debt is increasing and interest rates are higher than all of us are used to since before the crash of 2008. Where do we go from here? So we've got some slides from the Office of Budget Responsibility, which show some statistics, the forecasts for 2024. So inflation at home had appeared to start to fall, but we found out yesterday that it crept back up to 4% in December and expects to remain above the Bank of England target of 2% in 2024. Increase in staff costs due to an increase in national minimum wage, inflation, and the war for talent is a really key issue for our clients and businesses. The government wants to get more UK citizens back to work, but with further tightening of immigration rules, will this be enough to ease the pressure on staffing? So today, we're looking to tackle 4 subjects. So we're going to look at recent tax changes and what might be coming up next, the long-term outlook for interest rates, what investors should expect over the next decade, and then we're going to have a little look at inheritance tax and how potential changes could impact long-term planning. We've got the question and answer box active, so I'll be keeping an eye out on the questions, any questions that are coming in. Please feel free to ask anything that takes your fancy. John, would you like to talk us through this graph on the tax burden?
Yes, Nikki, thank you. And I think some of the point here is about what we think might happen after the election in the UK, which we're expecting this year, as opposed to many of them elsewhere in the world. And this is a nice historical graph going back to just after the war, and it picks up a number of points, and it also elongates out the more recent past. So you need to be a bit careful that the axes aren't the same. It's an OBR. It's an OBR graph. We haven't produced it ourselves, so that's a decision somebody else has made to try and highlight more what's happened in the recent past. And the key point, as pretty well everyone on this call I think will already be well aware, is that the tax burden is now very high, and it's continued to head up. And despite the promises, best endeavours, whatever you want to call it, of governments in the last 15 years or so, they haven't brought it under control, and we still have a substantial deficit. We have played with this graph a little bit more, and we've superimposed some historic governments on it. So we've got a kind of light blue for the Conservatives and a kind of salmony pink colour or something like that for Labour. We can get into champagne socialists if you want, but wherever. Anyway, so we've got the ones looking further back, and it's useful just to think about that. So we're in a point here. If you think what might happen going forward, so if we look at the right hand bit of that graph, you've got a line that's already creeping back up to where it was in the 50s, and possibly on that basis the same as it was just after the war. Now there are 3 basic possibilities as to where that line can go going forwards. It can go up, it can stay the same, it can go down. So that's quite simplistic in a way, but it's worth just starting with. If you look at the kind of history, there is no doubt that if you look at those kind of salmon pink periods, the graph has tended to go up from, left to right. It's gone up under Labour, and it has tended to come down under the Conservatives. So, as Chris will make clear to us later on if we ask him, past performance is no guide to the future. But you can see why many people would say that could be, what one is looking at happening again. That said, if you look at the kind of left-hand pattern, it's actually oscillating around quite a bit, that line. And so what you see is quite sharp increases and quite sharp falls. And you can get down to the precise timings and whether that's exactly to do with government policy and what happened and where you go. You come across to the right hand and a more recent pattern. And actually, it's already quite high, and it's been, if you get rid of that stretching effect on that graph and you bring it down so it's consistent with the more historic patterns, you're going to get a much more even line going along. So possibly, it's already at a level that's beyond the tolerance of the British people to really want it to go up much more. And some of that oscillating around we've seen in the past is kind of a feeling of where we're prepared taxes to be as a nation. And that if it drops down too low, we're prepared for it to come up. If it goes too high, we want it to come down. And therefore, there may not be scope for it to really go up much more. So you get to these three ones, up, stay the same, drop. Unfortunately, there's a fourth one that I think you need to bear in mind when we're thinking about this, is that this is quite simplistic in a way in terms of looking at the tax burden. It's an economist's view of how much overall tax is being borne by the country. If I take the individual people on this call, me, anyone else, we're actually much more interested in some particular taxes. And so over time, the burden of taxes, which taxes have featured in there has changed. And we'll talk a bit more about inheritance tax later on, but now inheritance tax is a very small part of that. Capital taxes, even under the Conservatives going back in the 80s, and now, have been quite low. You go back to the 60s or some of those Labour periods, and there was much more tax on wealth. And so if Labour can't get the taxes, down overall, they may still want to shift the composition of what's in there. But there's also what the Conservatives are looking to do or what they might do. So if we flip on to where we've been so far, now there's a lot of noise from the Conservative Party about inheritance tax, and I'm not trying to say that that's designed for a certain audience and the Daily Telegraph like it and they push it quite heavily and it plays well there. If you take away the noise and you look at the actual policies kind of going on, so what have we had from the autumn statement? Well, we've had a reduction in national insurance, and that's already come in from January this year. And that's a maximum reduction of about £750 a year, 754 we've gotten there. Now, the big gripe and whinge about it is, well, thresholds are frozen, personal allowance frozen, so that doesn't really help people in quite the same way, and wouldn't it be better to unfreeze those thresholds and allowances? Well, there are differences. For basic rate taxpayers, the personal allowance, if you index it, is a fixed sum, whereas the national insurance is a percentage kind of shift. So where you get to, and this is all about workers, all about people mainly being focused heavily on employees, what you get to is people earning above about 29,000, are better off. Below that, they're worse off, because the fixed sum of the increase in the personal allowance would have been better for those people. Now, bear in mind, above 100,000, the personal allowance is clawed back. Those people above 100,000 do still get that £754 benefit from their own work. So the Conservatives are definitely focusing the tax changes on people in work and who are earning, let's say, above 30 grand or something like that. Precisely how you view some of that and what you think of it and how it works out and how much of a tax rise it is going to depend where inflation turns out this year and how you adjust some of the other things. But if we then look at those people who are earning less than about 29, 30,000, and if we moved on a slide, the government's got a different strategy for, should we say, the lower paid workers, which is to shove the national minimum wage up. And we all get confused trying to remember precisely how you interpret national minimum wage and national living wage. But for most of it now, it's the national living wage. And so you've got substantial increases. You've got nearly a 10% increase for those over 23. You've got an even higher increase for those aged 21 to 22. So it brings it up to the same number. So we've only got one number for those aged over 21. And then still, a very chunky increase for those aged 18 to 20. Now, this is hitting's a wrong word. This is aimed at people earning in the low 20s, largely 20,000. So what you're doing is you're pulling the pay up. And then because you pull up the pay of those people, most businesses have got to adjust their differentials and pay the people above it more. So really, the government is shifting the burden of having to boost the earnings of the lower paid onto employers, whilst it's giving a tax break for those kind of further up the income scale, albeit you can debate how big it is. Where that takes you, though, if you look at a lot of our clients, is impact on retail and hospitality business. Will that cause more problem in terms of unemployment for younger workers? How attractive is that? I don't know, Nikki. I don't know. Is that helping? Does that? Where do you come in on that?
Well, I think in the hospitality sector, in particular, obviously staffing has been actually really challenging, but it seems to be getting a bit easier because you've got the service charges, you've got tips as well. So with a higher national minimum wage, hospitality is actually becoming a little bit more attractive as a proposition for employees. But from the business's perspective, then yes, it is costing a lot more. So we've got the cost of living affecting the customers as well. So we're kind of getting a bit of a double hit from a hospitality sector's point of view, because people are going out and spending less. We hear about all the pubs that are closing every week because people are deciding having to cut back, but also the businesses are having those increasing costs in staffing, as well as the power, gas and electric bills. So yeah.
And so what you're seeing is the government trying to boost disposable income a large part of the workforce, but on the hospitality sector, we've seen with people like Revolution looking to close bars that they don't think it's going to come through this year. And would the government carry on? Any government, are the Conservatives or Labour going to focus mainly on those in work and earners? Probably, I think, and therefore I think you're optimistic if you think you're going to see big tax reductions, outside of those things. But it's looking tough for a lot of employers of those type of people as we go into this year at the moment.
Well, if you think about the national insurance hasn't affected those of the pension age. So, and those individuals are actually almost better off because of the triple lock for the pension, and then the any savings they've got, earning a higher interest rate on at the moment. So, there's another side to think there. If you've got older people, they might have a bit more money to kind of go out and spend on that kind of sector.
Yes, and from that you can also say the government's chosen not to try and use its tax cuts to help those people because it feels they're already getting it from the triple lock, being the argument. Another one there. Anyway, there we are. That's my contribution.
Sorry, what about John? What about business rates? Is there anything?
Well, I think that it's an interesting angle to go to look elsewhere around it. I mean, what we're seeing is the government continuing with some COVID tax breaks, so the Conservative government at the moment, and factoring those into its forecasts. So at the moment, we show government revenue going up in future and the government being able to fund itself. But that does assume that business rates are going to go up as things like the 75% cut on hospitality businesses comes to an end. It also assumes that fuel duty is going to go up. And both of those, you've got to say, looking at our economy in this part of the world, is that really going to happen? So you've got the government, in in accountants, in our parlance, banking pretty optimistic looking things in its forecasts. We're taking on to bank and the funders, and more of that later, and pretty well saying, look here, we're going to be good for the money, but it's got some pretty optimistic kind of bits in there. And can it really push, business rates up in that way? Can the high street sustain that? We look at some of the losses, and what is happening over time is that business rates is becoming a less important source of revenue, because it just can't sustain what it once sustained. So, in theory, they're going up. In reality, I think that's going to be hard for any government to push up, which again means if they need the tax revenue, if the business rates don't go up, where do they go to get that tax revenue?
Okay, interesting point. Chris, if we come to you, what's the outlook for investors?
Thanks very much, Nikki. Good afternoon, everybody. I would have been introduced, but my name's Chris Rea, not that one. I'm the Managing Director of the financial planning business at Francis Clark. So I just wanted to touch probably for 10, maybe maximum 15 minutes on thinking a little bit about longer term investment returns and the long-term investment landscape. And I know many of you are interested in the subject or are invested yourselves. This time of year, you get a lot of outlooks from economists and investment management companies and people who charge you money to look after you. So I just wanted to stretch out the horizon a little bit to the longer term and really think about real returns, and bringing back into play inflation, which, for that period where a lot of us will have been invested, sort of post-financial crash all the way through to the pandemic, real returns, it wasn't really a concept because interest rates were, profoundly so low and historically so out of kilter with what the long-term norms were. But, we are back in that territory now. And I think, to give you the sort of 2 or 3 messages up front, I think over the next decade, real returns for investors are going to be somewhat lower than they were in that sort of golden period between 2009 and 2019 or all the way through to the pandemic. And that's partly because, as I say, I think, we'll cover this in a little bit of detail, but, the prognosis for interest rates, central bank interest rates is, very much gravitating towards historical norms. And, the investment management community, I think, will find it probably more difficult over the next 10 years really to find those consistent, easily available returns. So if you are invested, if you are an investor, or if you become invested, I think in this period, my message to you will be really to challenge your advisors and investment managers about what they see as the long-term outlook for your investment. And that's, I'll be talking to some people on the call where we're your advisors. You should be giving us a hard time on this as well, really understanding what we think the investment returns, are available for people. And that sounds like a slightly depressing message, and I don't mean it in that way. This is really about the realism of sort of returning to a much more normal economic state in the next decade. And it is definitely right to be invested. And I would argue, actually, as inflation sort of normalizes, it's probably more important to be invested than it's ever been, to give you that real chance of, making your assets really work for you in terms of your long-term planning. So thinking about the investment, landscape, the vast majority of what we do in our planning business, whether we are directly running investment mandates, for our clients, or whether we do the structuring around a pension or ISAs or any other structure, the investment mandate is really central to what we do. In fact, often describe it as sort of our superpower. It's the bit where if we get it right, we can, fundamentally allow clients to hit, what their sort of long-term, goals are. So it's a really, really important thing to us, and we're kind of fanatical about trying to get to a stage where we optimize those returns for clients. We don't produce anything ourselves, so none of these are our own products, and so I spend a lot of time along with colleagues talking to the whole investment management community really to understand what they think. And the primary question I'm asking them at the moment is where they see their investments management going over this period of the next decade. And I think for advisors, it's very easy to talk about the past, and we probably do that too much. Really good advisors will try to create scenarios looking into the future, and that was very much the spirit in which I wanted to sort of talk on the subject. So I'm going to contradict myself a little bit. Let's go back and let's just have a little think about this period that we've come through that ran into the pandemic. 2009 to 2019 will be seen, very much, as one of the golden periods, from an investment management perspective. Almost any strategy worked during that period. And in many markets it will historically, represent one of the longest bull runs that they have had. The S&P in 2009 was 650 plus. By the time it finished the decade in 2019, it had risen to over 2,800. 400% rise in that decade. Even the kind of poorly FTSE, which had to do with Brexit and all kinds of other things, that rose from high 3,000s in March 2009 all the way up, and it's doubled in value by January 2020. So it was actually quite hard not to make good money during that period, and that was really a feature though of some of these prevailing things we'll all recognise in the economic landscape, and nothing more so than very low, some people would say artificially low interest rates. If you looked at performance of well diversified, fairly standard equity portfolios, they were returning 8 to 10% fairly easily per annum, and the industry delivered on that. Inflation in, let's say, most developed economies was well below 3% on average across that period. So the risk-free rate of return, or the real rate of return for investors, was somewhere between 6 and 8% per annum. And the psychology of investing is really fascinating, and it probably is akin to a lot of the things that we do from an asset perspective in our life. But the behavioural element of this is that once we've had something this good, it's very, very difficult to wean yourself off that, and to change your expectations based on things. And I suppose part of the message is today, when I'm looking forward, the more I talk to the community, the investment management community, the more I'm seeing probably a more depressed expectation around the future of real returns. Gordon, if you just want to stick that slide up. So this is something this is not my work. We've taken this from Charles Schwab, but some of you will know them, a massive American investment house, a big research function. But investors here, the proxy here on the chart is sort of 50-year returns across various categories, but just focus on the two on the left. We've got big US companies and slightly smaller US companies. Over a 50-year period, they've returned fairly consistently an average of 10% per annum. Charles Schwab, taking everything into account, too much detail to go in on this section, but they're expecting returns perhaps to fall to between 6 and 7% around US equity over the next decade. If you then focus in probably that normalization of interest rates, it will start to bring pressure on real returns. The key planning point from this, though, which I have to keep repeating, is that this is a period where it's really important to be invested, because I think what we will feel as businesses and as households is, as inflation really does start to come back and we start to get used to it at this level, the returns that are available in well-structured portfolios with investment managers who really know what they're doing will really do mitigate the impact of inflation. So whilst the central message from an analysis point of view is lower returns over that period, the message from me is very much about the importance of being invested. Turning to cash, which has been a really important feature of asset allocation over the last couple of years, and investors have rightly asked, should we just take the safest option and sit in cash? That's not going to help you over the next 10 years. It will probably, the cash rates we expect to probably come down, and inflation, for most of us will be in excess of that. So again, it all speaks to the need to invest. Just thinking a little bit about inflation, I could see at least one question already on it, and it didn't surprise us that might be something which is at the front of your mind. I think the headlines for me about inflation generally, rates will moderate in the coming year in most countries in the world. And I think if we think of this particularly in the context of the US, the UK, and the Eurozone, we would expect interest rates to fall in each of those geographical areas, those markets. And I think the key takeaway from this is about this normalization, this returning to this sort of between 3 and 4% inflation. That's the sort of direction of travel. I've read quite a bit from economists starting to talk about this being a long-term path to again very depressed inflation and interest rates. But I think as the months go by, there's less and less serious analysis that really can support that. But for this year, I think the Eurozone will probably go first. They have very insipid growth in some of their big economies in Europe, and they really need whatever stimulus that they can provide. Probably expect the Eurozone to go first in terms of cutting. The US probably has the greatest potential to be able to cut. Reading analysis last week, expecting probably 4 to 6 reductions across the year, probably something early on, but then more as the year rolls out, but potentially up to 150 basis points, 1.5% reduction in the US. It may be fewer steps, or they may choose to do it in 6 steps to sort of maximize the positive press, particularly in and around the election. And I think we're thinking it's very much about a soft landing in the US coming out of COVID. There's certainly enough growth and potential in the US for that to be the case. A little bit less in the UK, probably in terms of reduction. So, we might see something like 3 or 4 0.25% cuts. I would see those much more as the year develops, though, and probably more built into the back end of the year. And for those of you who are less close to it, why now? Why are we able to cut now? Wage inflation for most industries is under some sort of control in a way in which it wasn't, certainly 2 years ago. Input prices, have leveled in a lot of industries, not all, but in a lot of industries. And those real difficulties in the supply chain, which were very much there during COVID, they have eased. But we're always open to shocks, and what's happening in the Red Sea is, I think proves that. And as far as inflation itself is concerned, it will fall this year, but I don't think that's going to be a linear situation. I did write these slides before Tuesday when we saw a very marginal tick up. I think they were blaming it on excise around cigarettes or something like that. But I think that is the profile. We're not just going to see some consistent linear fall. It is going to be a sort of bumpy landing for the aircraft. But in planning terms, I think it is a really useful time to think about. You will be doing it with those of you that run businesses, but from a personal perspective, really thinking about how you use this sort of information in terms of your planning, your cash flow planning for future years. I think is a really good opportunity to go and revisit that. We're really happy to talk to you about that, as I'm sure any other advisors are. That modelling around how inflation is going to impact your plans, I think is time really, really well spent at the moment. So, Nikki, I think I'm almost out of time, so I'm going to stop there. I'll invite John just to come in on inflation and interest rates, because we always have a good debate about this.
Yeah, I was just going to bring John in. So,
well, thank you both. And yeah, I mean, the key point, and you've got a couple of graphs there that are also showing it, which is interest rates are settling down to a kind of pattern that you can kind of work on over the next few years. And a couple of different graphs. I think one showing the first one in terms of looking forward, nominal forward curve on gilts shows it continuing to trend down, but is not even, but looking flatter. And then if you look at the kind of swap rates one, I mean, you can see a more consistent pattern there. And we've had this discussion, and you'd expect clients and us and others to be working on the basis that base rate's probably going to be somewhere between 3 and 4%. And one of the stats I tend to go back to, I think quite a lot, is something like the average mortgage rate from about 1992 to 2020 was 5.6%, and guess what? A lot of people are paying about 5.6% at the moment. Things do tend to revert to mean, and you can look at these patterns, and you need to be able to kind of adjust to them. The questions and people asking, what do we expect? What's going to happen? Well, it is interesting. Inflation ticked up a tiny bit, from a number that any of us would say was pretty much the same, 3.9 to 4%, basically the same number. And yet the pound edged up a bit because they obviously don't think that base rates are going to fall as quickly and that there's going to be higher interest paid in the UK. As a result, that hit earnings on the FTSE 100, with lots of earnings kind of coming across, and the FTSE 100 dropped, 100 points or something yesterday. So it's more stable, but it's still fumbling around. And I think people should be wary, again, ever the accountant, people should be wary about banking those interest rate cuts too quickly. They're going to come through. Interest rates are likely to be lower come Christmas 24 than they were at Christmas 23. But exactly how much and how far, it's hard to say. And you need to get your life to cope at the kind of levels that we're getting used to now, really. Does that help, Chris? Is that
Yeah, we agree.
It's always good. It's always good.
I just pick up on what there's a couple of questions. I think that Mike, thank you. I think hopefully we've answered that in some way, but do follow up if you want to answer that. There's a question here. What's the percentage expectation? Come close to the end of the market for real returns in the UK economy. I mean, I think it's interesting when you're talking to investment managers. There is I think there are those who are, very optimistic themselves about what happens in the next 10 years. Maybe they need to be, and I can afford to be slightly more hawkish about thinking this through, because we're on the coalface with clients, often really trying to help them, understand what is possible. Don't get me wrong with any of this. There is good money to be made always. In almost any environment, there is good money to be made for good investment managers. And what I really feel is that the next 10 years is going to separate the wheat from the chaff to some degree. I think that era of just buying anything and it going up in value, that's not what we're going into. So the best will still produce really worthwhile returns. Let's say inflation of 3.5%, you could easily get real returns of between 5 and 8% for those best in breed investment managers who really know what they're doing. Part of our job is to go and find them for our clients. We take that responsibility very, very, very seriously. What I'm pointing to is not everything is going to rise in value in the way it has in the recent past. So hopefully that helps a little bit.
Okay, brilliant. Should we move on to inheritance tax? John, what potential reforms?
I think that would be good. Yes, okay. Let's move on and talk about there. And I think Chris has got his own views here. I mean, in terms of inheritance tax, as I said earlier, there's a lot of noise about the Conservatives, for instance, saying that they might get rid of it. That plays well with a certain part of their audience, but I'm not sure it would play well throughout an election campaign. I think we're going to see a lot more noise about it. I think if they're wise, there are some changes they could make to it that Labour wouldn't look to reverse if they got into power, and would be reasonable ones to make. But I do think that any changes made to it could well be self-funding with other changes elsewhere. And you need to be very careful what you wish for in the space. So, if you look at the position we're in, and we've been in since 1992, is that you can have 100% relief on agricultural property and on business property, and you can still get that asset rebased for capital gains tax on death. So you don't pay any inheritance tax on death, and an asset gets rebased so that if you sell it immediately afterwards, there's no capital gains tax on it. It's not unreasonable to say that's about as good as it can get. That seems pretty optimistic. And given how heavy taxation is elsewhere, one of the things you could see is that rebasing going. you could see capital gains tax charges coming back in on death as we once used to have. So even if inheritance tax went, you could see other charges being there. I think that there is probably quite a lot of noise in parts of Britain about the amount of inheritance tax being paid on estates that aren't small, but they're not that big. You know, somewhere in the 1 to 2 million kind of territory, 1.5. And I could see that having a rate lower than 40% and simplifying some of it is something that could find favour. But I suspect that would be paid for by restricting some other relief somewhere else. I mean, Chris, you've got. Did you want to pick up on some numbers?
Yeah, I did put a couple of slides on this because I think IHT is one of those, you know, very easy political footballs to kick around. And you know, if you've never stopped to think about it, actually, what is IHT, who pays it, and what does it actually yield? It's a pretty unimpressive tax in many ways because only 4% of the states actually fall within the regime. You know, so the vast majority of people, this will never be an issue for, but it is disproportionately for the 4% who suffer it. And that's been pretty consistent. I mean, in fact that's a slightly higher number than it was kind of 10 or 15 years ago. Even lesser states fell into it. I think the other point which is important is that it doesn't actually yield that much. You know, from an exchequer perspective, you know, it will probably give the government something like 7 billion this year, which sounds like a huge amount of money, but you know, this pie chart is, you know, it shows that makeup of tax revenue, and it's actually so insignificant, 0.7% of total government receipts. It can't even make its way onto the pie chart. So you know, IHT then tends to get used, I think, much more, as what John is suggesting, you know, much more as a political lever which people can get behind or try to take apart. And you know, there has been, I don't think the Conservatives have particularly wanted to get into deep debate about it, but they've been quite happy for the headline to exist. You know, there has been some sort of complete abolishment. I think, as John says, that I think the problem with doing that is it is a disproportionate benefit to the wealthiest. And you know, whilst you know you might be a politician and not care about that very much, a lot of people at the moment do. You know, and I think if your tax change simply benefits the wealthiest, then you do open yourself up in entirety to a new government simply turning that around as a political move to say we're going back to the regime that was there before, or maybe even a more dynamic regime, as you know John was pointing to. So I think this is sort of a political question, this one, as much as anything else. From a planning perspective, if anybody was saying to me, you know, Chris, we've spent time really thinking about this as a business, as a family, you know, whatever, that time has been really well spent. You know, the best IHT conversations are really not about the legislation and about the tax treatment. They are genuinely about how you set yourself up and having really great conversations about what happens on demise. And if you've had those, then that's always going to be time well spent. If you've put arrangements in place specifically to mitigate it, you know, I think all good advisors would tell you to stop and wait to think about what's going to happen here. This could easily play out in a number of different ways. And, you know, I think the time you spend working on it and probably the time you spend putting whatever you have in place has not been time or energy wasted. So I don't think that this is one of those, you know, upcoming changes where we need to rush to really think about how it's going to, you know, impact those people who have taken planning advice on it. And I think it is equally as likely just to fall away in the general conversation around the election as it is, you know, to become a central piece of it. And I think we could all see the Labour Party, if there was a complete abolition, you know, choosing this as a lever really to show, you know, that they're interested in the, you know, the common man or woman in the street. So I think you know, I think we're broadly agreeing on that.
A couple of further points from me, if I could. Sorry, just there. I think useful probably to share. I have got clients stalling on doing things on inheritance tax, waiting to see what happens. You know, again, you know, we've got a March 6th budget. Let's let's see what comes there. And those are things like, if you're going to put a large amount of money into trust and you're going to pay a lifetime upfront, that's a 20% upfront inheritance tax charge. You know, that's a perfectly rational decision. Okay, you've got the things about the time periods and the rest of it, but you can go, well, if you put £1 million into trust and you've got to pay a 200 grand upfront charge, if that upfront charge could have gone to 15% or something like that, you could have saved 50 grand for waiting for a couple of months. Yeah, that seems like a sensible thing to do. So I get that entirely, and we have those conversations. But I think I'm with where, Chris is. The arrangements look favourable at the moment. There's plenty you can be doing. It's good to have conversations. It's good to work out what you're doing. That it'll all be okay, I'll just put it to one side and let's see what happens, is not the way to go. The other point from me is a more academic point, but goes back to some of the conversation things I was making earlier about tax burden. I have many exciting books on my shelves at home. I've dug one out which tells me how much death duties raised in the tax year 1938-39. I'm sure you've all got this at home, but in case you haven't, it was 8.6%. And so, Chris is telling us 0.7 here. For a lot of the 20th century, death duties and wealth taxes were very, very high. And if you don't know, in 1938-39, that was a Conservative government. It was, Chamberlain in power, and had been for some years. If you go to Thomas Piketty or some of the others, the key achievement of the 20th century for trying to level up and get more money was high death duties. So you don't have to go too far to see where the political persuasion of the other party is. Tony Blair never wanted to go near inheritance tax. Actually, if the Conservatives mess around with it and Labour come in afterwards, I think it could go up a lot more than it is at the moment. So you do have to be a bit careful what you wish for on this, I think. Sorry, Nicola, did you want to come in there? Chris, come back. Yeah.
No, I think maybe I covered that one.
Sorry, I think I just lost connection for a second there.
Oh, don't worry. I thought I just stunned everyone into silence.
Yeah, sorry about that. But if we look beyond the general election, which no doubt is going to happen at some point this year, Paul Johnson of the IFS has said that after the autumn statement that Jeremy Hunt or his successor is going to have, and I quote, is going to have the mother and father of a headache when it comes to making tough decisions in a year or two's time. What do you see as the biggest challenge facing whoever is Chancellor after the next general election, whatever colour that might be?
From my perspective, I think the trouble is trying to get the economy to grow, to grow and to get growth. We have to be a bit careful where we go, in case I sound like some kind of, Liz Truss's kind of love child or something at this point. And I'm not trying to, but, the way I tend to see it is that we've been through a long period where the strategy by Cameron and Osborne was to kind of hold down spending and basically try and get the numbers to balance by not spending as much. And if you look at this, it's difficult to adjust it to kind of household approaches. But, you can do that for so long, and it's one thing to economize. But really, if you're not getting your living cost to work properly, often you've just got to try and get more income coming in, get another job, earn more money, get something else. We've got to grow. And the problems I see with a lot of that is how you shift that. I think the structural problems in the tax system of the thresholds that are just disincentives, the personal allowance clawback at 100,000, the high income child benefit one, the amount of people being dragged into high rate tax, before we even get to things like student loans, and you add 9% on to many parts of the population, and they go, who can be having with this? So I think that's a key part. Planning reforms, I think, are key. How do you get education, other things up? These are all very important things. I read an interesting article in the New York Times recently where they said a lot of the big problems in the UK is lack of connectivity to the national grid, and that things that you're trying to expand and get businesses going, you can't get it. So structural infrastructure matters. I think if we could just pull up another slide here. The other part that just worries me and continues to, I think if we flip you look at the interest burden that we've got, you look at the debt burden. I mean, there's some figures on here, which is that, after November 23, the forecast interest cost for 2026-27 was 109 billion. A little while earlier it was 93 billion. We're running about 100 billion pounds. To help people with some context for that, all company taxes, absolutely every one of them, corporation tax, energy level, bank levy, all of these stuff, they raise about 97 billion pounds a year. So you could scrap all of those if you weren't paying that interest cost. And there's no sign of that interest cost going away. And because we're running an ongoing deficit, we've got to issue gilts. We've got to make those gilts attractive to people around the world. And my concern is it just continues to squeeze out me being prepared to speculate money in more risky investments, because I can get 5%, let's say, or 4%, or whatever the number is. So it's got to be a good one. So these are where I think a lot of the challenges are, and they're not easy. Does that help, Nikki? That was my...
Yes, it was very comprehensive, John. Thank you.
Well, and I don't want the job. I mean, for a lot, when I was younger, I thought that sounded like a wonderful job. I think it just looks horrific. So to any of them. Anyway, yeah. I don't know whether Chris has got anything to add on.
Yes, Chris, have you got anything to add?
I mean, my fundamental feeling is we've got to get the cost of running a business down. That's what we hear a lot from people who are running businesses. They're keen to do it. They have the imagination and talent to do it, but it's so preclusive, the costs of actually trading, that they wake up some days and think, why do we bother with this? And that, I think, that does fit into that longer term assessment of returns. I think one or two of the things which might allow us to sit here in 3 years' time and you go, Ria, you're wrong about everything that you said, are things like input prices around fuel. If we can really harness some technology to get the cost of things like fuel down and embrace some technology there to produce synthetic fuels and these sorts of things, these are the kinds of things that will really help businesses and really help those input prices. We seem to talk about machine learning and AI in a very negative way, like it's going to destroy the workplace and everything goes with that, but actually it has some fundamentally exciting ways of improving the ways in which businesses are run. And I think we will come to see it less as this just existential threat and much more as a piece of how we construct supply chains and how businesses are run. So I think we're going into a period, and there was a question which I haven't got enough time to answer in detail, but I think someone's asking about what does the asset allocation look like in a world where real returns are more difficult to come by. And I think we will go back to a time where we actually start to look much more at companies. So, should I invest in the UK? That's a pretty macro question. If you break that down to, are there great companies here which are really profitable at doing great things and will in future? There are. The UK is full of great companies. And actually, I'd much rather, from an investment perspective, we got back to thinking about how we invest in really great companies. In a way, that's what's happened, in the US. There was another question about, should I be invested in the US, nervous about the election, potentially. Actually, if you look at that bounce, which, happened just before Christmas, most of that came through those companies that we could name in the States, which really have propelled the global economy over the last 3 or 4 years, and all the way through that period I was describing earlier. They're predominantly tech-based, they're big, they dominate their marketplace, they're global, they can distribute well, and so on. Those companies are going to continue. The biggest ones continue to be in the US. So I think from an asset allocation perspective, it would be foolish to move away on the basis of political concern. And if you just look back at what happened the last time Trump was elected, assuming that's what happens, looks more likely, is that this time actually the US economy didn't react in the way in which everybody thought it would, which was a hiatus of running around, trying to put fires out. That didn't happen. And, I think good investment managers probably look at that and separate the political, the potential political disruption from fundamentally in the US. There are lots of very, very good companies making a lot of money, and that's a great reason to invest there. But I think bringing it back to the UK, because there has been something you might see in some press, is the UK now, it's been somewhere where investment managers have sort of moved away from both the sterling but a UK bias generally. And whilst I think that will generally be the status quo, I think what good investment managers will come and find those companies, those really strong companies, which we could write down if we had longer, but which will produce great returns. So actually, I'm probably more optimistic about the UK than some others. But I think we are back to a stage now where we can start to think at a more micro level about the sorts of companies that are being really successful here. But I think listening to business owners, the UK can become a much better place to do business if we can just make doing business a bit easier.
Thank you to everyone who submitted questions. They were really interesting, and John and Chris were picking up ones as they were going on. They were keeping an eye on the questions coming in. If we haven't responded to your question, then we will have a look and try and get back to you afterwards, or please get in touch with one of us afterwards. Contact details will be on the website. So thank you very much to everybody for joining us today, and thank you, John, and thank you, Chris. Really insightful. We do have another webinar coming up, I think on the 25th of January, and there it is, the information on the screen. Thank you very much, everyone, and have a good rest of the day. Take care.